Hi guys, today we are going to discuss a bit about the rise of Bitcoin, significant price action noticed recently, including of course gold, what has driven it, what to expect at least towards the end of the year. I was joined with Rufas as we discussed the recently increment in interest rate by the Central Bank of Kenya, what has driven it, of course, what to expect in terms of your personal finances. We also delve into the commodities markets, that is oil, what to expect from the OPEC, and perhaps if their influence is waning. I believe this was an informative session, and enjoy. Good morning. I hope you're having a wonderful day wherever you are. Welcome to another episode of Bullish Banter. Hey Rufus, how are you?
I'm very fine. How are you doing?
I'm good. It's been a minute.
Yeah. It's just a week ago.
Yes. For context, guys, we haven't recorded, let's say, in a couple of days. So we are just catching up, and a lot has happened since the last time we were discussing the markets. Bitcoin setting record highs, gold setting record highs, Kenya government increasing interest rate. A lot has happened.
Yes.
It's like every time we go away, something major must happen.
Yeah, I tend to think of December as a slow month where the markets or the volatility in the markets kind of slows down towards the Christmas period.
Yeah.
From what I'm seeing, today being the 6th of December, volatility has gone a notch up, a notch higher, and this is crazy. It means that we might be busy in the markets until the end of the year.
That is definitely true. Santa Rally is truly back, yeah?
Yes.
Yeah, I've been calling it for a while, but you didn't believe me. Now we have it.
Okay, when you say Santa Rally,
yes.
What do you mean? Because from what I'm seeing in equities, they have kind of topped, and they seem to be going back downwards. But volatility on FX is on another level. Then commodities are kind of crazy. Gold going all the way up, then back down.
I think when I mean a rally is, let's say, if you are investing in a particular asset class,
yeah,
and let's say 3 years ago it was the equities market.
Yes.
But this year around, it's at least on the commodity side or alternate investment vehicles.
Yes.
So if you look at Bitcoin, it's still rallying. I don't think it has, let's say, reached its peak.
Yeah.
If you see gold, I don't think it has reached, let's say, its peak.
Yeah.
So for equities as well,
yeah,
I think we might still have maybe a few more pips to wrap up the year, because all numbers indicate, let's say, a continued weakening of the dollar,
yes,
and the demand for other asset classes,
yeah,
as a sort of a hedge against the oncoming recession talks. So that is what I mean by Santa Rally, continuation of higher pricing, higher levels, and obviously if you're on the right side of it, definitely a good year to wrap up your 2023.
Definitely.
Yeah. Maybe we can begin with BTC. I know there is the talk of ETF. I'm not really buying onto that hype.
Yeah.
Is it that now, given even in Kenya, they have already started a process of legislating on cryptocurrencies as a security?
Yeah.
Is it that now clarity has, let's say, gotten into investors, and therefore there is a significant demand, not only just for trading purposes, but actually, insurance of your retirement and stuff like that?
I think what we are seeing happening with Bitcoin is more of a flight to quality. So if you're anywhere in the world, you tend to realize that over time, your currency is depreciating over time as a result of inflation.
Yeah.
So a lot of individuals, corporations are looking for assets where they can hold and retain their purchasing power or retain value. And Bitcoin has come out as a clear winner. So if you have been putting your money in equities, you're safe. I think especially American equities. So if you parked your money in S&P 500, the NASDAQ, the Dow Jones, you're probably beating inflation, meaning that your return year to date is higher than the inflation rate. But then if you put your money in cash, there's a good probability that you lost money when you factor in inflation. But then for anyone that just parked their money in Bitcoin, they are currently making some good returns.
Obviously, it goes without saying, this is not an investment advice. So perhaps if you are never really invested in the sector, you might want to read more about it,
Yes.
learn about it, and then make your own at least decision. Because I know for me, I think it has started to behave like other investment vehicles.
Yeah.
It had it, let's say, correction price towards the end of last year, early this year.
Yes.
And it has only risen up. And I think one of the things about crypto, given that it's, how do I put it? Its uniqueness and hype around it and the tech side of it, people tend to get in on the train when it's almost arriving at the station.
Yes, for Bitcoin, I would say, and to be precise, year to date, if you just packed your Kenya shilling into Bitcoin, you'd be up 227% since the beginning of the year.
Yeah.
And if you did that in dollar terms, then you'd be up 163% today. So this basically means that you would not have exposure to counterparty risk, where there's an intermediary in between. You would not have to trust anyone. Just Bitcoin, buy Bitcoin, store it in your own self-custody, and you'd have that return.
Yeah.
But then at the same time, if you compare with other investments, then you'd realize that this is becoming more of a superior or apex asset class, where you are assured of retaining your value over time, and you don't have to take any risks.
Yeah.
So if there was ever a risk-free asset, then I would call this Bitcoin.
I would not go that way, but, I don't think there is any risk-free asset.
Yeah.
It's only, how do I put it, free of risk, but
No.
there is definitely some, like I said, for me, when I started to learn about it, it was very volatile.
Yeah.
Of course, there is a CFD version, which is tradable, but also there is obviously the other done on the exchanges. Me, personally, I think I would recommend, of course, the person to do the research, because you remember, like I said, people get in on the train and it's almost hitting the station, and that bear run, that is why I compare it to the mainstream market. It will always have its downtime. So understanding what drives it is very important compared to people making prediction. So at some point, Bitcoin per Bitcoin, it will be 100,000. At some point, maybe it will be 1 million. I think those sentiments is like calling NASDAQ at 50K and all these numbers.
The thing is, at a fundamental level, 1 Bitcoin is equals to 1 Bitcoin.
Okay.
But then if you're comparing it with with another asset, let's say you're comparing it with the dollar, then you expose that variation or valuation with the volatility in the dollar itself.
Yeah.
So when you see, let's say, Bitcoin moving from, let's say, a low of around 15K, then rising to the current level around 44K, it's not more of what happened to Bitcoin, it's more of what happened to the dollar.
Yeah, definitely. To another commodity and another group of significant players in the markets, OPEC.
Yes.
Do you think?
OPEC Plus has been kind of consistent with what they are looking to achieve, but then it's turning out to become a fully blown out war between the OPEC and non-OPEC countries. They are contrasting initiatives and goals. So on one hand, and I will try to define this. So the OPEC, the oil producing and exporting countries, are ganged up together into one cartel that controls over 50% of the global oil supply or exports. So what they normally do, they will basically sit down and allocate quotas. So for this country, you produce this country, you produce this, and once they agree, then they have a controlled supply of oil in the market. So the goal that they are normally trying to achieve is a certain price level where all countries are profitable and they retain certain stable prices for oil. But then what we have been seeing is other non-OPEC countries having contrasting goals. So on one side, the OPEC plus countries, which are led by Saudi Arabia, Russia, we have African countries like Algeria, Nigeria, and Gabon, and so on. So they have all been trying to prop up oil prices. Propping up oil prices has had the impact of causing inflation around the world. So if you look at the Western side, led by the US has been fighting this battle against inflation. It peaked at 9.1% last year in July. And then they have been trying to drop this inflation back towards the 2% target. So at some point in the year, I would say in the third quarter of this year, we saw oil rallying for like 3 months, and this resulted in higher inflation across board for Western economies. But then the US and other non-OPEC nations have been propping up their production. And as a result of higher production of oil, they have increased supply and added more downwards pressure on prices. So as a result, we have continuously seen oil prices going down. The overall outcome is looking like this. OPEC plus nations are just cutting their oil output. Non-OPEC countries are expanding their output, which means the market share is moving from OPEC countries to non-OPEC countries, whereas the prices are still profitable. So when you look at oil prices at above $80 or even below at $75 or even $71, which is the lowest we have seen this year, all those prices are still profitable. So if you're cutting output at profitable prices, then you're not having an impact on the market, you're only losing the market share.
Yeah, that's what I've been, let's say, because I sometimes tend to trade oil because of its, PIP value is quite greater.
Yeah.
There is that risk that I think has crept into the market.
Yeah.
The unpredictability of fundamental news impact on the prices.
Yeah.
You will see, let's say, I think there have been talks of increasing the cut in production plus 2 million a month, but the prices keep on going down because it is counterparted by Nigeria, for example, an OPEC country increasing their production.
Yeah.
They are for matching that which is removed from the market. US has been emptying their reserve for the last almost, I think, 6 months, and therefore matching the global supply. Now, as a trader, you are wondering, is it likely to go down? Because typically when they cut production, the supply reduction will increase the demand price and therefore going upwards. But I guess that is not really felt in the market.
Yeah, I think a significant development we have seen this year is the US removing some sanctions on Venezuela.
Yeah.
And Venezuela is a big producer of oil. So by allowing Venezuela to sell oil to the West, it has really ramped up production. Also, the US has expanded its local production, leading to more exports. And of course, most of these exports are ending up in Europe, where after bombing the Nord Stream pipelines, Europe is now heavily dependent on US for both oil and gas. So as a result of that, we are seeing an increased supply in the market. So despite Europe having this recession environment, especially Germany, we have seen oil prices continue to go down because supply is rising and demand is not very strong in Europe.
Now, I think we have spoken now from the analyst trading perspective, from the consumer's perspective. I think it's a good thing because if the prices keep going down, it gives me an idea. Perhaps the CPI print for December will definitely keep on going down for most countries. And that can be a good thing in terms of as people get into the year, the fears of recession might be reduced, and therefore we might see maybe, let's say, stable prices in the equities market and obviously market participation. Coming back to Kenya, do you believe oil going down to 60s will mean the prices of fuel going down?
No way.
Yeah.
From what we are seeing around here, first things first. The Kenyan government is heavily dependent on a couple of sectors for tax revenues. It's heavily dependent on heavily taxing energy. So from Kenya Power bills being extremely high, oil being extremely high, and of course it's also heavily dependent on Safaricom. So for every transaction you make using Safaricom or mobile banking app, then the government is heavily taxing that. So those three sources tend to contribute out of revenue for the government. So even if oil prices at a global level continue going down, there's a good chance the government will be taking advantage of that rather than giving that relief to the people.
Okay, interesting. Yesterday, that will be on 5th of December. I think that was the biggest, let's say, news in the country at the moment. And for me, what I found interesting on the hike by 2% was just after the tap sale of the latest infrastructure bond, whereby the rates were going at around 17%. How does that impact bond holder, for example, who bought, I know we have spoken about it before 10 years ago. I think they will continue bleeding, if I'm getting that right.
Yes, I think it was a betrayal of the highest order from the central bank. For me, it doesn't make sense.
Okay.
This week, you issue bonds worth $40 billion. Then, after you issue those bonds,
40 billion or 4 billion?
40. It was all 40 billion. Sorry, not dollars, shillings.
Yeah.
40 billion shillings. So after issuing those bonds, the following week, you hike interest rates by 2%. That's 200 basis points. So immediately, the overall impact of hiking interest rates by 200 basis points to 12.5% has the impact of hiking the yield on bonds. So the yield on bonds will probably rise by a similar valuation. So we could be seeing the yield on bonds rise by 2%.
Yeah, to like 20s.
Yeah. So what does that? What that does is completely devalue the 40 billion that was just issued last week, meaning that you're stuck in that position and you can't sell your bond. You'd have to hold it to maturity for you to realize the full value.
Yeah.
Otherwise, if you sell in the secondary market,
Definitely.
you'll be selling at a loss. So I think that was a betrayal.
Okay.
But then, on the other hand, it doesn't make a lot of sense. And this is my reasoning here. Remember that the central bank target for inflation is between 2.5% and 7.5%. So with the inflation rate ranging between 6.8, 6.9, and then back to 6.8% in the last 3 months, it means that the central bank has achieved its target of reining in on inflation. So though we are close to the upper limit, remember the range is between 2.5 and 7.5. So having this inflation being within target, it doesn't make any sense for the central bank to go for 200 basis points rate hike. So I understand that last week we had the National Assembly or Parliament basically calling to almost fire the current central bank governor because he has not been able to stabilize the shilling. So with the shilling continuously sliding to the dollar and eventually hitting 160, yeah, it's still quite a challenge. But if you go for a 2% rate hike, I think, yes, on one hand, you might achieve some stability within the shilling, but it's going to hurt the economy more. So right now, if you go and take a loan from a commercial bank, you probably get a higher interest rate. And I think these interest rates are almost approaching levels that I would call them Shylock levels.
What?
The interest rates with commercial bank loans.
Okay.
So it makes it even more difficult for companies to expand production given the economic conditions and still honor debts at current interest rates. So this basically heavily discourages production. And from the report that we saw with the Stanbic PMI, showing that companies are freezing hiring and others are cutting jobs, then there's a good chance that we are going into a hard landing.
Definitely. Interesting that you bring up hard landing. And I agree with you that maybe inflation, I believe, is still quite high. I don't think the 7% really reflects how the expendable income of people is at the moment, the level is.
Yes.
But recently I was listening to some economists, at least within the US, saying that if you looked at the job opening numbers that came out yesterday, and probably what you'll see in the NFP on Friday, in the US generally, the jobs market is heating up. Less people are getting employed, more people are filing for unemployment claims. So that is the first, let's say, sign of a crack opening again, or rather widening, that we have been talking about the year. Secondly, the flight to gold is not just, let's say, normal.
Yeah, it's not normal.
Yeah, because that spike was quite huge. And I believe that's why I believe there is still some room for it to continue hitting that high. And of course, Bitcoin as well, and perhaps some few stocks in the equities, rather, few equities within the indices, which is actually driving the prices to the higher level. My point being that, yes, we have seen US maintain their interest rate, but if they are still maintaining the hawkish sentiments, we might continue bringing it back home. Maybe the dollar still gaining some strength against the shilling, and that combined with the interest rate hike might make the economy a little bit maybe choke at some point, or some sectors basically sort of experiencing sharp declines.
Well, I would say there's quite a number of cracks that we are not focusing on clearly. One of the cracks that I saw this year was that in previous years, when you focus on the three most traded days in terms of retail purchasing, we know that Americans purchase a lot of goods on these 3 days. On Thanksgiving, the following day is Black Friday, and then on Monday you have Cyber Monday. So those 3 days command the highest retail purchases ever on any single year. So normally, investors will be tracking the numbers or the trends to see how many sales have been made over that 3-day period, and then they would invest in those stocks that are bound to benefit from such increase in purchases. However, this year, what we saw is a shift in that trend. So instead of investors going for companies that are actually selling products like Amazon, Walmart, and so on, we saw a lot of bets going into the companies financing those transactions. So this year, the biggest gains were on PayPal, which is a company financing the transactions. And of course, another company called Affirm, which is a company that provides buy now, pay later services. Meaning that the appetite for purchasing products during those 3 days was still significantly high, but then people are buying these products on debt. So investors are betting on the companies that are providing this debt, and some of the beneficiaries include the buy now, pay later companies. So this shows that the consumer, especially the US consumer, is still significantly strong, meaning that they have a strong appetite to buy products. But then at the same time, they don't have the purchasing power. They don't have the savings to spend on these products. They are buying these on debt. So if you look at the trends in US credit card debt, which recently broke above $1 trillion for the first time ever, it means that people are still buying more products at high interest rates, but then they are doing so at the expense of higher debt, meaning that at some point they will hit a certain limit. If you are just expanding your freezer limit and buying more and more products, at some point you are going to have to stop purchasing those products. And I think that will be a key leading indicator for the oncoming recession.
Interesting. What I think basically speculators within the stock market or Nasdaq in general are going for the shovels.
Yes.
That will be used to dig the gold.
Yeah.
And after that, if I've been following closely, yesterday and today, those particular companies, their prices are going down. Like PayPal was down yesterday 3%.
Yeah.
Affirm was down around 2.7%.
Yeah.
That would be, for context, around 6th of December.
Yeah.
But I think the main drivers of the Nasdaq so far are still quite resilient, even despite the news that some of their CEOs and executives are selling off their shares. So perhaps back to my Santa Rally, let's say, view, the magnificent 7 companies still attract a lot of demand in the market. So at least traders should be looking for, some correction in the prices, temporary correction.
Yeah.
But the main play, at least those companies are driving the market significantly. Remember, I think if you notice, there's a day Dow Jones hit around 5% after the Salesforce report.
Yes.
And that was the only contributor to that price action. Yeah. So I think for traders, as we approach December, I'll be looking at some of these cyclical consumer goods to see if people are maybe spending more.
Yeah.
And now look at the financing side of it, because those will be primarily the drivers in terms of price action as we approach the end of the year. Yeah,
despite the drop in Affirm yesterday, it's still up 17% in the last 5 days. So basically means that there was quite a number of strong bets on that.
Exactly. Yeah. So I guess for traders, maybe you can look into those. It'll be very vital for you as you try to get some Christmas gifts for your parents and everything. Maybe as we sort of wrap it up, is Japanese yen finally stable?
Well, I don't think the Japanese yen is stable. One of the key reasons we are seeing is that the Bank of Japan has not come up with policies or policy suggestions saying that they are going to hike interest rates. Mm-hmm. So what's actually happening is the pairing, I would call it the pairing, it's more of a misconception where you see the Japanese yen strengthening against other currencies, but in real sense, it's investors betting against these other currencies. For instance, the chances for the US cutting interest rates are increasing. So the market is already betting on a 25% chance that the Fed might cut interest rates on its next meeting on January. So there is almost 100% chance that it's not going to do anything in December, 25% chance cutting in January, and over 50% chance that the Fed will cut rates in March. So with these odds increasing that the Fed will pivot, we are seeing investors betting ahead of time. Remember, the markets are forward-looking. And as a result, we have seen the dollar index weakening over the last 4 weeks. So going forward, if the dollar index is just weakening against other currencies, then you might see other currencies rebounding, like the yen strengthening against the dollar. The pound has been strengthening against the dollar, the euro, and so on.
Yeah.
However, this does not give us the full picture. It doesn't show us any fundamental basis for like bidding the JPY higher. So at some point, we will be following the US data closely to see if there's indications of further softening of the job market, further softening of the real estate market. And those are the indicators that the Fed is looking forward to. And if inflation softens towards the 2% target, then the chances of a pivot become increasingly high. And in that case, those other currencies will have a chance, including the Kenya shilling itself.
Okay.
But then before we get to that, if something happens in between and the Fed, by any slightest means, decides to hold rates level at that level for longer, then we could be seeing the dollar resuming strength and getting to newer highs against these other currencies. But for now, all indications are showing a weaker dollar, and other currencies will obviously take advantage of that.
I think for me, I'll be looking at the NFP data, how the markets react to it, and of course PCE,
Yes.
the last PCE of the year. After that, I think the trend that will be formed post those two major data sets will sort of close the year as it is. But next year, I guess we'll have a very strong reversal, especially after the first Fed meeting, and maybe how the ongoing crisis within Hamas and obviously Israel is sort of addressed. I think those will be my highlights. And let's say 2 pieces of data that I'd be worried about as I look at my trading.
The funny thing that I realized, and I was looking at an article this morning, showing that almost 50% of the S&P 500 companies have been mentioning AI in their earnings call this year. In the last quarter, that is the third quarter of 2023, over 50% of the earnings calls, they mentioned AI. So CEOs basically saying, this is what we are looking to do, this is how we are using AI to improve our products and so on. But then a study that was conducted just a month ago showed that about 4% of American businesses are actually using AI to produce goods and services. So you can see 50% of S&P 500 companies are mentioning AI in their earnings calls. But then the number of companies, like for the overall population in the US, about 4% of businesses are actually using AI. So it means that there's more hype than actual use of AI to produce goods and services.
I guess maybe it's more or less about mismatch on where to allocate the artificial intelligence basically to it. Is it maybe in communication? Is it maybe in maybe responding to clients' queries? I think that is the issues. Most companies, they are using it, yes, to look futuristic and techno-wise, but not really being strategic about how to make the most out of it, either to reduce their cost or even maybe increase client communication and efficiency out there.
Yeah, the thing is, everyone is jumping onto this new trend. But the real application of AI to improve, let's say, production and distribution of your goods and services is still very low in terms of adoption. So this means that going forward into next year, there's still more room for more companies to actually adopt AI, and that would probably increase their valuation. But at the same time, looking at the current stock valuations, there's still a very high proportion of companies that are overpriced because they mentioned AI, while in real sense they're not applying AI in production or distribution of their products.
So are you calling maybe some bearish move will be expected at some point early next year?
Yes, some stock valuations are crazy high, and it doesn't make sense.
Okay.
For some companies like Coinbase being up over 300%, at some point we will be expecting a correction going into next year.
Yeah.
And perhaps it could even start as early as this month.
Okay.
So going forward, and from what I'm seeing with the NASDAQ and S&P 500 pulling back downwards, we could be seeing some form of rotation. And I think we started seeing this last week.
Okay.
With the Dow Jones spiking higher, while the NASDAQ and S&P 500 were going down.
Definitely.
And that was not the correlation earlier in the year. Earlier in the year, it was mostly tech and S&P 500 going higher and Dow Jones lagging. And now we are seeing the opposite. The Dow Jones rising higher and NASDAQ and S&P 500 dropping lower.
Yes, for retail traders, opportunities lie in plenty. Volatility is up, so that means that if you are a scalper, couple of pips to pick from the market, and I guess that will perhaps maybe be a very good way to spend Christmas. You are at your home,
Yeah.
Roasting whatever you are roasting, while also looking at your empty 4 or 5.
Roasting ramen noodles.
Definitely. That has been.
There was this crazy thing happening in US yesterday.
Yeah.
So there was this special sitting for Senate where they were discussing a potential bill that will be voted today on passing some funding for both Israel and Ukraine.
Yeah.
And this one was being pushed by Joe Biden and the Democrats.
Okay.
So the Republicans literally walked out of the meeting very angry, and they said that that was a waste of their time.
Okay.
So the big contrast was happening as a result of their issues not being given enough weight or respect. So they had a very strong opinion about border security. So they have been raising a lot of concerns that the border crisis in the US is becoming so huge that a lot of immigrants are coming into the US and they are not being controlled, and it's becoming bad for the US economy. So the Republicans are pushing for border controls and more funding to the border
Patrol
controls.
agents.
But then Biden and the Democrats are not considering that. They're only interested in raising more funding for Ukraine and Israel.
Do you think that will have an impact on the next, I believe it is January 22nd, after the extension on budgetary allocation?
Yeah.
Do you think that will still have some, impact, especially because that will mean maybe the government raising more treasuries, and then we are able to see again yields maybe now going back up as they were cooling down, something like that?
Yeah, the Republicans vowed to basically vote the bill down.
Okay.
So if they have their way later today, the vote is happening today, then it would mean that there is less funding for Ukraine, or zero funding for Ukraine, zero funding for Israel. And this could be the potential end of the Russia-Ukraine war.
Interesting.
So Russia has been preparing to attack Ukraine, especially during winter. We are already in winter. So potentially, if the US dries up the funding for Ukraine, this could be the end of the war. And if the war ends between Russia and Ukraine, then there's a potential high appetite for lowly valued European equities.
Interesting.
So the centenary could potentially happen in European equities.
By the time this episode will be out, I guess we'll know how that pans out.
Yeah.
I hope you have enjoyed that. We expect, of course, some questions from our audience. And definitely, before we wrap up the year, we'll definitely do a special pod just to wrap up the highlights of the year and obviously key features or data sets or fundamentals to watch out for, including the return of, Donald J. Trump.
Definitely. So as we approach the end of today's podcast, we'll be making an open invitation. So if you are an economist, market analyst out there, trader, and you'd like to participate in the Bullish Banter podcast, you're more than welcome. Just reach out to us. And we will welcome you and continue discussing the good content and, of course, some banter here and there.
Adios.